Good evening, class, and welcome to our performance management class for today. We have been looking at variance analysis, and during the previous class, we learned the basic variance analysis. We started our discussion from a standard costing. Then we went into a fixed budget. Then we looked at the actual results at the end of the month or end of the period, and we saw the need to create a flexible budget so that variances can be calculated. We looked at the cost variances, which are direct material costs, direct labor, variable overhead, fixed overhead costs. Then we look at the sales variances. Then finally, we saw how we could reconcile all the variances so that we can be able to explain the difference between the budgeted profit and the actual profit. Today, our discussion will be on advanced variance analysis. And so we are taking the basic variances we've learned so far to an advanced level. What are some of the things we are going to be seeing here on advanced variance? We're going to look at material mix and yield variances. What do they mean? We'll find out. Then we'll look at sales volume, mix, and quantity variances. After that, we'll be looking at something called planning and operational variance. Then finally, we'll be seeing market share and market size variances. All right, so let's go straight down to the discussion for today. Now, material mix and yield variances. When standard costing is used for products that contains two or more items of direct materials, the total material usage variances can be calculated by calculating the individual usage variance separately and then adding them up together. So it means that if, for example, product X is produced from 3 direct materials, and the materials are material A, material B, and material C, and they are mixed up in a process, together in a process. Okay, they have a particular mix, a kind of a formula mix. The following information relates to the budget and output for January. So let's see this example here. We have our materials here on standard cost, A, B, C. It means that when we say standard cost, we want to look at what is the component for 1 unit. So for 1 unit, we will need 1 kg of material A, 1 kg of material B, and 8 kg of material C. So when you add these quantities together, you are having 10 kilograms. 1 unit uses 10 kilograms, but in separate materials. Then we look at what is the standard price per kilo. So material A in the market, you can buy 1 kilo for 20 naira. In material B, you can buy 1 kilo for 22 naira. And for material C, you can buy 1 kilo for 6 naira. So how much will you spend to make 1 unit of our product? If we are to use material A, and you bought it for 20 naira per kilo. Since you're using 1 kilo, standard cost is 20 naira. For material B, standard cost is 22 naira. And for material C, because you are buying 8 kilograms for use for 1 unit, and you are buying at 6 naira per kilo, 8 times 6 will give you 48 naira. So when you add the cost for A, 20 naira, that of B, 22 naira, and that of C, 48 naira, you have 90 naira for 1 unit. That is the standard cost for 1 unit. Okay? Then actual, you now produced 200 units. Now, when you produce 200 units, you decided to use 160 naira, 160 kg, 160 kg for material A. You use 180 kg for material B and 1,760 kg for material C. And so the total quantity, kilogram of materials you used in making the 200 units is 2,100 kilograms. Now, how can you calculate material usage variance? You can decide to take material A, standard and actual, and you compare. Then you take that of material B, you compare. Take that of material C, you compare. And then you add A to B to C, standard, compare with the total of A, B, C, actual. Now let's see it that way now. We have in material A, if you are to spend 1 kilogram making 1 unit. Now, when you are to make 200 units, it means that you are going to spend 200 kilograms. Now, you spent 200 kilograms. That is what you are supposed to spend. That's standard flexible budget now. Plan for 1 unit. So how much quantity will it take you to do 200 units? 200 kilograms. But your actual quantity used is 160. And so is that a favorable or adverse? You plan for 200 and you use less than that. So the difference is 40 kilograms. Favorable. That's fine. Then when you look at the costs, the standard costs for 1 kilogram is 20 naira. You multiply that by 40, it gives you 800 naira favorable. So you have done that for material A. You know, in basic variance, we are just using 1 material. So now in advanced variance, we are now seeing a mixture of materials because in production process, you need to mix different materials. Let's say you're making bread, you need flour as a material on its own, you need egg, some other things. These are materials. So as many materials as there are, you're going to calculate their material usage variance separately. We now go to B. For B, if you are to use 1 kilogram for 1 unit, then for 200 units, you are going to use 200 kilograms. And how many did you actually use? 180 kilograms. And that's it here. The difference is 20 favorable because you use less, 20 kilograms less than what you planned. And if the price for 1 kilo is 22 naira, that means 20 times 22 will give you 440 favorable. Okay, so that's for B. So we'll go to C. If you are supposed to use 8 kilograms for 1 unit, and then you went ahead to do 200 units, 8 times 200 should give you 1,600 kilograms. But your actual result shows that you use 1,760. But when you compare, it means you used more than what you budgeted, what the standard was. And so the difference of 160 is adverse. And if it costs you 6 naira, it means 160 adverse times 6 naira will give you 960 adverse. And so after getting their individual variance, usage variance, you can now add together to get the total usage variance. So you're going to add this 20 favorable with 440 favorable. When you get to adverse, do your minus. And so that's what you do here. If the resulting answer is a positive, then you have a favorable variance. If the resulting answer is a negative, you have an adverse variance. So, but the answer is 280 favorable. So it means your overall total usage variance is 280 favorable. So that's how to do material usage variance. That's not all. Let's look at substitutable materials. If the materials, you can substitute one material for the other. Let's say you need 100 kilograms to complete your production program, your production process. Maybe material A and B are substitutes, and you need 100, only gets 80. It means you cannot use material B as a substitute for material A. So we compensate for the use of that lack of 20 that you are experiencing in material A. So when that is done, it means that you can now analyze your variances into mix and yield variance. Into mix and yield variance. Note that it is only when there is substitutes, when they are close, when they are substitutes, they can be substituted for each other, that you can do mix and yield variance. Otherwise, you simply just do your usage variance as it was, as you did before, and forget about mix and yield variance. Now, when you add your mix variance with your yield variance, it will give you your total usage variance. Okay, so for example, let's look at the direct material mix variance. And let's see how we can do that. The material mix variance measures how much of the total usage variance is attributable to the fact that the actual combination or mixture of materials that was used was more expensive or less expensive than the standard measure mixture materials. All right, so we're going to see the process for calculating material mix variance. See that the mix component of the usage variance indicates the effect on cost of changing the combination or proportions of material input in the production process. We'll see that in an example. Now, the material mix variance is calculated as follows. And we're going to be making reference to that example. One, the first step, take the total quantity of material. We are going to take 2,100 units. That is the total quantity of material used. Not total quantity of output of product, no, total quantity of materials used to make the output. Now, we are going to use 2,100 kilograms in example and calculate what quantity of each material in the mix should be if the total usage had been in the standard proportion or standard mix. And now what I mean here is the standard mix 1 kg is to 1 kg. So we want to know how many kg would they have used to make if there were 2,100 kg. How many kg would have been used for material A, material B, and material C following this mix? So it means there's going to be a mix, which is called a mix. Then the second one is compare the actual quantities. Compare the actual quantities of each individual materials that were used and the standard quantities that would have been used, which is the standard mix, if the total usage had been in the standard proportion or mix. So we're going to do that. Then the mix variance for each material expressed in kilogram is the difference between the quantity of each material actually used and the quantity of that material that should have been used in the standard mix. The total mix variance in material quantities is always 0. We're going to see it in the question. Then we're going to convert the mix variance for each individual material into money value by multiplying by the standard price per unit of the material. These figures are summed to give a total mix variance. So we're going to take a question now, and we're going to look at these steps and see how we can follow these steps. This page 231, let's see how we can follow these steps. All right. So let's go. Let's go to a question here now. Now look at it. You have the first one is your actual mix. This is your actual mix that represents this actual mix here, 160, 180, 760, giving you 2,100. That's what you have here. Then you have your standard mix. The standard mix is this, this, and this. So it's as good as saying 1 is 10%. This is 1 over 10, 10%. 8 over 10 is 80%. So that's what is done here. 10%, 10%, 8%. If you don't want to write 10, if you don't want to put it in percentage, you can do it in fraction. 1 over 10 1 over 10, 2 over 10, then forget the fraction. So it means that if you are doing 2,100 kilogram, 10% of it should be for material A. So that means 1 over 10 times this 2,100 material A. That means you are supposed to use 210 kilogram. The same thing for material B, 210, and that of material C is 1,680. So we've carried out step 1 and step 2. We've carried out step 1. We are going to carry out step 2, and okay, that's what we just did. Carried out step 2. Now, step 3, the mixed variance for each material is the difference between the quantity of each material actually used and the quantity of material that should have been used in the standard mix. What it means here, you are going to find the difference between this figure of 160 and this figure of 210. So you know, standard is what you budgeted for. You have your standard of 210, and so your standard mix is 210. Your actual mix here is 16. So what is the difference in mix variance? Is 50 favorable because your mix in actual was 50 better than the standard. Material B, this is your standard mix for 21 units. For 2,100 kg, you're supposed to use 210, but now you are using 180. That means you have 30 favorable. And then for material C, when you compare standard with actual, you will find out that you used more than the standard. So you have 80 favorable. And now they told you that they said the total mix variance in material quantities is always 0. So can you see the 0 here? You can get it in 2 ways. 50 favorable plus 30, 80 favorable plus 80 adverse. That gives you 0. Put another way, 2-1 minus 2-1 is 0. All right, so now you've gotten the standard mix here as standard mix, the mix variance rather as 0. What is now the standard cost? We were told that 1 kilogram of material A is 20 naira. And so you multiply by 50, that is the variance, you have a mixed variance in naira of 1,000 naira, favorable. Here you have 30 kilogram of variance, favorable variance, multiplied by 22 naira. That gives you 616 naira favorable. 80 kilogram adverse, it's 6, it gives you 480 adverse. And so when you add 1,000 plus 660 and you minus 480, it gives you 1,180 favorable. Now that is your mixed variance. So that's what we just did here. We did step 4 and step 5. So that's how to calculate your mixed variance. So you bring your actual mix, you get the total quantity. You now convert it to standard mix for this total number of quantity, knowing that you have a standard mix in the standard costing. You have for one output, what is the standard for one output? That is what you are using. Find the mix variance in kilogram, multiply by the standard cost to get your mix variance in Naira. Now it says here for each individual item of material is favorable when the material mix is less, when the actual mix rather is less than the standard mix. And the mix variance is adverse when the actual usage exceeds the standard mix. And the total mix variance is favorable in this example because the actual mix of material used is cheaper than the standard mix. But that's how to calculate your mix variance. So we said before that your mix variance is an indication of the effect on profits of having an actual material mix that is different from the standard material mix. So costs on changing the combination from the standard mix to the actual mix. So how does it affect the costs? So that's what you just did. And let's look at another type of variance called the yield variance. The material yield variance is the difference between the actual yield from a given input and the yield that the actual input should have been given in standard terms. What does that mean? We're going to see that when we do an example. But notice here that it indicates the effect on costs on the total material input yielding more or less than the expected. They said there are several ways you can calculate yield variance. So you just use the one that makes sense to you. All right, so let's look at one example here based on the example that we just used here, that the standard costs for each unit. So look at the standard costs for each unit. That is for 1 unit, the standard costs. 1 unit, we spent 90 naira. That's it, 90 naira is what we spent on 1 unit. And we spent it on 10 kilograms. So it means that the standard cost for each unit of kilogram. So 1 kilogram, how much will it cost you? If you spend 90 naira on 10 kilograms, it means that 9 naira per kilo. And of course, 90 naira per unit. So that's it. Now, based on outputs, so this is method 1. Based on outputs, let's see how we can do a material yield. Now, this compares the actual yield to the expected yield from the material used. The difference is then valued at the standard cost. In our example, 10 kilograms of materials is what gave us 1 unit. Okay, so is it here? 10 kilograms gives us 1 unit. Okay, now we used 2,100 kilograms to do 2,000 units. And so see what it says here. If we use 2,100 kilograms, how many units should we get? We simply divide 2,100 kilograms by 10 kilograms. It should result in 210 units. So if we are using 10 kilograms for 1 unit, and you now decide to say, okay, let me use 2,100 kilogram. How many units should you get? You are going to get 210 units. But wait a minute, you used 200 units. You got 200 units. Wow. So what happened? So the way it is this. 10 kilogram should yield 1 unit. So that is what is called yield variance. 10 kilogram of materials should yield 1 unit of output. Therefore, 2,100 kilogram of material should yield 210 units of output. That is what it says here. Then, how much output did the 2,100 kilogram really yield? Wow. You now yield an actual unit of 200. You're supposed to yield 210, but when you check your actual, it was 200. So what happened? Is it a favorable variance or an adverse variance? Well, the difference of 10 is adverse. So look at it this way. Look at it this way so that you understand. You have 2,100 kilogram of flour. And so standard cost taking 10 kilogram per 1 unit of bread. It means that if you are doing 2,100 kilograms of flour, you are supposed to be producing 210 loaves of bread. But when you now did it, actually you now got 200 loaves of bread. Now, did you do well? No. You had a shortage of 10 loaves of bread, which is adverse. So it means that you did not meet up to the yield that is expected of you. So it's like saying that this is your cutoff mark, and you now went below the cutoff. That means you have 10 adverse, right? So the standard cost here now is 90 naira per kilo. So when you do that and multiply by 10, it gives you 900 adverse. All right. So this is output method. So why is it called output method? It's because you are saying that you are comparing the expected output with the actual output. So that's it. What is the expected output if I use 2,100 kg using 10 kg standard for one? What is the expected output? And what is the actual output I got? Was it up to what I'm supposed to expect? Now let's look at input method, which is method 2. Input method. This compares the actual usage to achieve the yield to the expected usage to achieve the actual yield. The difference is then valued as standard cost of input. Now look at this example here. Look at this example. 1 unit, so yeah, it's an opposite of the output method. In the output method, you started with the inputs. How many inputs should yield output? But now in input method, we are starting from the output to see how many inputs you are needed to get. So here you have 1 unit should use 10 kilogram of input. And so how many units did you actually do? 200 units. So it means that if 1 unit should use 10 kilogram, therefore 200 units should be 200 times 10, which should give you 2,000 units kg. So it means that for you to do 200 units, the input material should not be more than 2,000. But how many did you use? You used 2,100. So you wasted 100. So yield variance in quantity is 100. So it means here now, I said it's the opposite of output variance. So this is what you should use. If you use more than that, it's adverse. If you use, so this yield variance in input method seems to align with the way we reason with cost. Now, when you check your standard and your actual, if your actual is higher than your standard, it means to have an adverse. If it's lower than your standard, you have a favorable variance. So these input methods seem to follow that. Whereas the output method, you are looking at a cutoff, and if you exceed that cutoff, that means so you have if you go below that cutoff, you have an adverse. If you go above that cutoff, you have a favorable variance. So whichever makes sense to you. Now that you have 100 kg as your input variance, um, um, yield variance, the standard cost is how much did you buy 1 kilo? 1 kilo is 900 kg, 9 kg. And so when you multiply 9 kg with 100, you have 900 naira is the yield variance. So you can see here, the same 900 adverse is what we have using both the input and the output. Now the difference here is if you want to know which method you are using, you're using the output, your starting point is the input material that gives you that output. You're starting from, you're using the output input method, your starting material will be the output material, the output that's going backward, how many inputs is required if you are to make that output. So that's the difference now. So if you see here, the first input method, the variance is in number of units. And so the price, the standard cost is the cost for the final output. That's output method. But here the variance is in quantities in input. And so the standard cost here is the price per input material. So that's your yield variance. And so we have our mixed variance plus our yield variance should give you equal to the usage variance. So our mixed variance, we had, let's get where we had that mixed variance. Let's get it here. Okay. First of all, this is our total variance, 280. How did we get our mixed variance? Mixed variance, we had 1,180, which is the same thing here, 1,180. And our yield variance, which we just solved right now, happens to be 900 adverse. So we have a 900 adverse. So favorable plus adverse minus adverse, everything is 280 favorable. Just the way we had it in the usage variance when we are doing them one after the other. So you see that you can separate your usage, material usage into mix and yield. Now, things to note here is that material usage can only be broken down in mix and yield, or you'll be doing yield variance. So you just only do your usage variance. But when you have A, B materials, you now look at mix and yield. And some criteria is they must be substitute materials. If they're not substitute materials, then you cannot do so at your own and see how you can be good at them. Okay, we'll not be taking the alternative. Okay, you can look at the alternative method here and see how it actually helps. So we'll not be looking at the alternative. Now look at factors to consider when changing the mix. Analysis of the material usage variance into mix and yield components is worthwhile if management have control of the proportion of each material used. Management will seek to find the optimal mix for the product. Process operates as near this optimum as possible. The identification of optimal mix involves consideration of several factors. One of them is costs. The cheapest mix may not be the most effective, may not be most cost effective. So the fact that a mix gives you a cheaper value may not be effective. A favorable mix variance is offset by an adverse mix. Sorry, a favorable mix variance is offset by an adverse yield variance, and the total cost per unit may increase. So you need to take note of that. Sometimes when you have a favorable mix, you might have an adverse mix. So what it means is that you have a mix, you have a cheaper mix, and maybe your yield became, adverse. So where you gained it in the mix by changing the mix, but your yield became worse. Then we look at quality. Using a cheaper mix may result in a lower quality product, and the customer may not be prepared to pay the same price. So a cheaper product may result in higher sales return and loss of repeat business. So it means that if you have a cheaper product and your customers buy the product and they go home and they feel that, oh, I've wasted my money, you will not get customers anymore. They will start running away from your product because you try to get a cheaper mix for your yield using a bad quality product. So these are some of the things you are going to consider when changing your mix. And when we say changing your mix here, it means that, let's say you're supposed to make something, you're supposed to use 8 kilograms of a particular material, and say because you want to save costs, you now use 6 kilograms. You change the mix. And when it starts giving you a bad yield, don't cry. All right, so we've seen mix and yield for direct materials. So take notes, direct material usage. So it means that a question can come up with basic and advanced together. You may be given direct material and you have material A, B, C, you are asked to find the total direct material variance. And you now do it by looking at the price variance. So you will now look at the price variance, which has nothing to do with the material ABC. Then when it comes to usage variance, you now look at the ABC quantities in mix and yield variance. Now let's go to something else that looks like what we've just done: sales volume, mix and quantity variance. So see here, the yield has changed to quantity variance. Now let's look at the sales variance. When a company sells more than one product, a volume variance can be calculated for each individual product in the usual way. You know, when we are doing sales variances, we have volume variance and capacity variance. So now it is the sales volume variance that is looking the same way as material usage variance. So the sales volume variance can also have sales quantity and mix variance. So when we are looking at more than one product, we can calculate the usual way to get sales volume. Now, in such cases, the total sales volume variance is sum up of the individual sales volume variance. So let's look at one example here. The following information relates to the sales budget and actual sales volume result for X incorporated for the month of March. Now, this is product X, product Y, product Z. This is different from material X, Y, Z in cost variance. But when we are looking at sales, we are not looking at materials, we're looking at final quantity, final output, products. So we have X, Y, Z, different products. And we budgeted, so that's the sales, this is the standard budget we are making. We budgeted to sell 240 of X, 140 of Y, and 120 of Z, making it a total unit of 500 units budgeted. And I look at the unit contribution. So when we make our sales less variable cost, our contribution per unit is 50 naira for X. And so when we multiply 50 by 240, we have 12,000 for X. Y is 70 naira multiplied by 140 gives you 9,800. And Z 120 multiplied by 60 gives you 7,200. Now, when we add all of these together, we have a total contribution of 29,000 naira. All right, so now when we have 29,000 naira as our total contribution, now what is the standard average contribution per unit? So what we'll do now is total contribution is 29,000. How did we get this 29,000? By selling 500 units. We budget to sell 500 units and we are having a total contribution of 29. So what is the average? Now it's called average because we are leveling everything together. Average contribution per unit is 29,000 divided by 500. That will give us 58 naira. So that is our average contribution per unit. So when we got that, now look at the actual sales we made. For X, we made sales as against 240 we budgeted. For Y, we made 220 as against the 140 we budgeted. And for Z, we made 180 as against the 120 we budgeted. And so the total actual sales is 600 as against the 500 we budgeted. How can we calculate the individual total sales variance? Let's do that for X. For X, the actual, that's what we start with, actual quantity sold, 200. Standard quantity or budgeted quantity is 240. That means we have a shortage, it's adverse, of 40. So when you have set a target and you went short of it, you have an adverse. And the standard contribution margin is 50 naira. So it simply means here that you have a variance of 2,000 adverse. Now going to Y, you set that you want to produce 140, you want to sell 140, but lo and behold, you went above it and sold 220. Your variance in units is going to give you 80 naira. Multiply that by the standard contribution per unit. That gives you 5,600. So in the same way for Z, you have a favorable variance of 60 multiplied by 60 naira per unit's contribution. That's 3,600. So if you have to add all of them together, X, Y, and Z, X is negative, it will give you a total contribution of 7,200. Now, this is total sales volume variance. You did volume variance for X, that of Y, that of Z individually, then you added them together. Okay, so having done that, let's look at this explanation here. In the above example, there are two differences between the budgeted unit sales and the actual. First, the budget was to sell 500 units, and now the company actually sold 600. Second difference is that the company had budgeted to sell 500 units containing a budgeted mix of units, X, Y, Z. So they have quantity they have budgeted to sell of each. But they now have 600 units with different mix of these items. So we have quantity mix and sales mix. So the quantity mix is that of 500 versus 600. The sales mix is that of XYZ mixture in the standard or budgeted and the actual. Now let's look at it more closely. Let's look at the sales quantity mix variance. Now look at it here. The sales quantity variance indicates the effects on profit. Remember when we are doing usage variance and we said mix variance, it is the effect on costs. Now for sales, it is the effect on profit of the total quantity sales being different from that of the budgeted quantity. So you see here, the sales of 600 units is different from the budgeted 500. And we're going to be assuming that they are sold in the budgeted mix. So these sales, if you understand direct material usage variance very well, we are applying the same principle here. So it means that as we are getting that correctly, we are going to be understanding sales quantity mix and sales quantity variance and sales mix variance. Now look at the format here. Budgeted sales in total was 600. actual sales in total. This is 500. So now you have sales quantity variance in units. So let's see how they did it here. Sales variance quantity in unit, that's 100. Now what is the weighted? Now the weighted is the average standard contribution per unit. We saw it in our example is 58 naira. So that means 58 naira multiplied by 100. It means your sales quantity variance, the standard contribution mix, is 5,800. So that's simple. You take the budgeted quantity, you bring your actual quantity, you less from the order, you have the favorable or adverse, then you look at the average standard contribution value, get your variance. So this your contribution, the contribution that varied from the standard. Okay, let's look at how we can get our sales mix variance. Sales mix variance. Now that's different from sales quantity variance. Now, if you look at it very well, the sales mix variance indicates the effect on profit of having an actual sales mix that is different from the budgeted sales mix. Now, it's just like looking at the direct material cost and you say it has an effect on cost when you change the usage mix, the standard mix. Now, this is the same thing here happening in sales mix. We have changed the budgeted sales mix to something else. So now let's see how we can get our sales mix variance. One, the sales mix variance is calculated by first finding the budgeted mix in percentage terms. So you can leave it in percentage if you want to, or you can leave it in fraction. So it means that, let's look at it here. Okay. It means that if we are doing 500 units total, and you want to take 240 for X, what is the percentage of X to the total? So 240 divided by 500 is as good as saying 24/50. Or it looks like 48/100, which is 48%. That is what we are saying, 48%. Then 140/500 looks like 14/50, or 28/100, which is 28%. Z, of course, is 24%. Now, after getting, this is their mix, apply the percentages of the actual total, apply the percentages to the actual total sales to give you the actual number that would have been sold if the standard mix were used for the actual sales. So what it means here is that you decide to sell 600. If you sell 600, that means for X that you have 48%. So you are going to calculate 48% of 600. It means that X should have sold 288. So that's what it means here. Look at it here. For this figure, X is 48% of 600, which is 288. All right, now the third one here is the mix variance for each product is the difference between the number, that is this new figure you've calculated, and the actual sales of that product. So it means that you are comparing, since you said you sold 600 actual, how much is the standard budget that you would have sold for X, given the standard mix? 288. So that's the standard. How many did you sell? You sold 200. So it means 288 minus 200, that will give you 88. That will give you 88. So where is this 240 coming from? Okay, sorry. You have 240. Okay, yeah, I get what I mean now. The mix variance for each product is the difference between this number and the actual sales of that product. So you have 240 minus 288, that gives you 48. This means that the company has sold 48 units less of X than it would have sold if the actual sales were made in the standard mix. Okay, then the fourth one here is the variance for each product expressed as units is multiplied by the standard contribution per unit. And when you sum their variances, you have a total variance. So let's look at it here. Actual mix. And wait a minute, I was correct when I said it's 88 and not 48. Sorry. So that's a mix up here. So actual mix here for 600, your actual mix, we got it from this budget here, that this is supposed to be 48%. So actual mix, if you're selling 600, you have to sell 48% of 600, which is this is the actual here that was sold. 200, 220, 180. That gives you your 600. Fine. The standard mix is, if you are to sell 600, 48% of 600 should give you 288. 28% of 600 should give you 168. And 24% of 600 should give me 144. So you see, once again, 600 minus 600 will give you 0. Go up, down to here. The adverse and the favorable will give you 0. So when you less 200 from 288, 88 adverse, it means that this is the standard that you would have been sold. That's the standard, the cutoff, but you sold less than the standard. That's adverse. But in these other cases, you sold higher than the standard. That's adverse. So to have a way of compensating each other. Now you look at the standard contribution per unit. Now we have this 50 naira. Where did we get it? Look at it here, 50, 70, and 60. So that's what we did here. And it gives you their individual variances, which when added together gives you 1,400 favorable. So you see here, the total mixed variance in units must come to 0. So the actual and the standard at the same figure must be 0. When the actual and the standard are the same figure, this must be 0. And that shows that you have correctly applied these percentages well. Now look at example of sales quantity variance. The sales quantity variance. Look at sales quantity variance. We have 1,400. Where did we get that? Look at the first example here. Sorry, sales mix variance 1,400. Yes, then your sales quantity variance, the one we did before was 5,800, all favorable. When you add them together, that gives you your 7,200 total volume variance, which we got before when we started these equations. 7,200 favorable. So you see here that you have now splitted your sales volume variance into quantity variance and mix variance. Of course, there's an alternative method, but I believe that this common sense method is very, very important. So the common sense method is what I advise for you to use. Now, there is something else we want to do in advanced variance. This is called the planning and operational variance. So I'm going to talk a bit about it. Then perhaps the next class, we are going to dwell on planning variance and operational variance. Then we look at the market size and market size and market. Okay, that's that's an offshoot of planning and operational variance. So I'll just talk a little just to whet your appetite on it. We're not going to take it today. In planning and operational variances, you are looking at budgets and the need for you to revise a budget. So because some things happen unexpectedly, there may be a need for you to revise your budget. And so you'll be saying things like original budget, which you use in doing your actual basic variances, and whether that the standards have changed. You may now need to revise the standard. And so you now have original standard, revised standard, and actual. So the original standard, having been outdated, when compared with the revised standard, will give you something called a planning variance. And when you use your revised standard to compare with your actual variance, actual quantity, you have the operational variances. And we'll be telling you the reasons for all those variances. You get something called ex ante and ex post standards. So the ex ante is the original standard which we use in our example. The ex post standard is the revised and more realistic budget which we'll be using. And we'll be seeing how we can use it to perform material variances, labor variances, to get both planning and operational. Then we shall be looking at, let me get that name well. Let me get the name correctly. We shall then be looking at market size and market share. That's it. Market size and market share. When we do that, that will conclude our discussion on variance. So I don't want to rush through all of these because rushing them will defeat the purpose. So for now, the advanced variance we looked at now is direct material usage variance, which can be splitted into two: direct material mix variance and direct material yield variance. Note that you must have more than one material to do this. There must be substitutes. Okay, then we have the sales volume variance. And so can divide them into sales quantity and sales mix. One thing that makes these two similar is that there is either material mix, there is a mixture, which is a standard mix. So for sales volume variance, for the mix variance, you have a sales budget mix. For the material, you have material mix. So always watch out for the mix. Convert the mix to percentage or to fraction, and you are good to go. Now, I want you to look at those examples we practice questions. Please look at them. Any of them could be an exam question. You may not know. It can be they may enlarge the use of that question, those practice questions in the exam. And that way, when you practice this and you get it correctly, by the time we finish variance analysis and you take any question on variance, you will understand where the examiner is going, because variances are always arranged almost similar, almost the same way. So thank you so much for coming to class today, and please do well to revise all the things we've been learning. Don't worry, we'll come to variance analysis. Do have a wonderful day and stay blessed.